everybody? Tim Bratz here with the Legacy Wealth Show podcast. Excited to be here and excited for our guest, Mr. Chris Litzler. Chris is a huge, been a longtime friend of mine and a huge asset to our team. He handles all the commercial finance side of things. He's with Marcus Millichap and their commercial finance division. He's been doing all my loans for several years and knows the ins and outs of commercial finance better than anybody else I know. And just a really, really good guy to be working with and a huge asset to our team. So Chris, welcome to the show, brother.
Yeah, Tim, happy to be here. Thanks for having me.
Cool, bud. So, obviously the name of the show is Legacy Wealth Show, and we're talking about how to build legacy wealth. How not only just making money, but keeping money and then getting your money working for you. And you're in an industry, obviously, of being commercial real estate and commercial finance, of seeing a lot of legacy wealth built. So maybe you can just give a high level of what you do, how you do it, and then let's dive into some of the questions that I have for you that I know other people are going to have for you. And then I want to talk a little bit about some of your clientele and what you've seen just from a mindset perspective across everybody that you do business with and people that are worth, multiple 8 figures, multiple 9 figures, multiple 10 figures. So tell me a little bit about what you do, man.
So yeah, Tim, thanks for having me on. And yeah, I'm happy to share a little bit of our experience in the capital markets recently and going forward. So yeah, so we range debt and equity for commercial real estate transactions. Typically loan sizes between 1 million and up. We did about $1 billion worth of commercial mortgage financing out of our Cleveland office last year. And we're well on pace to hit that again in 2019. So what we do is arrange debt and equity primarily with banks, life insurance companies, CMBS, Wall Street money, Fannie, Freddie, all the agencies, whether that's short-term money or long-term non-recourse permanent financing. We have relationships with all of those institutional lenders across the United States.
Love it, dude. You guys are obviously doing some big things. And as you mentioned, you do debt financing anywhere in the country. So essentially, if somebody wants to go buy a property, they would come to you. You could help them set up the loan, which typically, obviously, rates vary and terms vary and all that kind of stuff. But for a lot of my loans, for instance, it's 75 or 80% loan to value. And then I go out and I raise equity, meaning I raise the down payment from my investors. You can actually help with that too. You've done that with other investors, right?
Yeah, absolutely.
It just kind of depends on the terms and what all that needs to shake out as. And then you can sign up the loan and then help them out with any future, either refinance or whether this is a bridge loan or permanent financing, all those kinds of things. So talk about the different types of loans, just for anybody from a high level. You mentioned the agency debt. What is that? What kind of terms? What are the benefits of that? You mentioned life insurance companies. You mentioned local banks. All three of those different categories. There's some benefits and some costs and disadvantages to using each one of those. Talk a little bit about each one of them, just from a high level. Take a couple minutes on that.
Sure. So different lenders are going to be better at different types of loan products, right? When you think about a bank, you think about matching your assets to your liabilities. So banks have deposits coming in every single day, and they want to put their money out shorter term to match the duration of those deposits. So when you think about shorter term floating rate under 5-year loans, you think about traditional banks. So that's construction loans, and that's bridge loans, and that's typically smaller commercial properties under $1 million. That's really where the banks are going to want to play. They are almost always full recourse. So
what does that mean?
Full recourse means a personal guarantee of repayment of the loan, right? So they're looking at not only just the collateral of the subject property, but they're also looking at the warm body behind that loan.
So for anybody listening, so the local kind of community banks, that's who I use in order to go and get financing, as Chris mentioned, on some of those smaller type deals and on bridge loans. Bridge loans are kind of like short-term loans for commercial real estate, construction kind of loans. although it's not new construction, it might be new construction, or it's something that is usually a little bit more distressed too, than maybe an agency or a life insurance company, right? The banks will touch stuff that's
Correct.
maybe a 60 or 70% occupancy versus something that needs to be at 85 or 90% that a traditional agency kind of lender, institutional lender would lend on. So the thing is the bank's not only looking at the property, they're looking more at the borrower and the borrower's ability, because the property sometimes is performing, sometimes it's not performing, right?
Yeah, that's correct. So the banks are going to be able to take a little bit more risk, because in addition to the collateral, they're also getting a guarantee. So they're looking at the sponsor's global cash flow, total liquidity, total net worth, and kind of saying, well, we'll take a little bit of risk on his construction loan because we know that Tim has the financial horsepower to carry this thing in the event that something does go wrong.
Mm-hmm.
That's the opposite really of the life insurance companies or the agencies or CMBS, right? Those typically are non-recourse loans. So you're only guaranteeing a loss in the event that you trip what they call a bad boy clause. So non-recourse loan is going to be made really 100% based on the durability and the stream of cash flows of the collateral, right? So as a result, those lenders are going to take a little bit less risk. They're not going to want to make a loan on a super distressed asset because they're saying, well, if this doesn't work out for Tim and he hands me the keys back, I don't really want to take back this type of product. So the agencies and CMBS and life insurance companies, generally speaking, are only making loans on stabilized assets.
An agency is like Freddie Mac, Fannie Mae, those kinds of lenders, right?
Correct. And I would probably add in HUD to that category as well.
HUD, yeah. So, for anybody who is listening, there's something called a bad boy carve out. So essentially, if you lie, if you cheat, if you steal, if you're grossly negligent, if you're fraudulent, if you take a loan and you never make a payment, then those loans through these life insurance companies and through the agency lenders can turn into recourse loans. But one, you need to default, right? Two, you need to trip one of those clauses. Three, they need to take back the property. Four, they need to sell it at a loss, right? So there's a lot of different dominoes that need to go down. And one of the things that I know we always talk about is, as my net worth increases, I want my safety net to increase with it to make sure that if something did shift, if something, outside of my control happens, I'm not personally, or I have very minimal liability in that long term. So that's why I like putting, once a property is stabilized, a lot of times what we do is we'll buy a property with either some sort of bridge loan or construction loan through a local bank typically, which is recourse. But my model is to buy it, stabilize it, renovate it, stabilize it, put good management in place, and then refinance it into this agency debt long term to hold the property. That way I can cash out my investors, and then we just have, essentially agency money in play. And it's a longer term, usually fixed interest rate, longer amortization schedules, and it's non-recourse. So that's a way that we are working really hard on pursuing that angle to make sure that we do reduce our ongoing liabilities. So tell me a little bit, and you've gotten a couple of these for me. If it doesn't fit into either of those buckets of either agency or life or traditional bank, like we've done some pretty distressed deals, and there's debt funds out there that do that. So tell me a little bit about what the debt funds do.
Yeah, sure. So our goal, of course, as your kind of consultant or broker, is to kind of put you into the right product that fits your long-term objective. So if it doesn't quite fit where a bank would play, and it's not quite stabilized for some longer term money, there are some debt funds out there that are traditional real estate lenders that will come in and offer you what we call a bridge loan. So that's fuller leverage, call it 75, 80, even up to 85% loan to cost, anywhere between a 1 and a 3-year deal. Can be recourse, can be non-recourse. Usually a 1% origination fee, and then no exit fee depending on who you refinance it with. And it gives you that capital and flexibility to be able to get in, handle your stabilization efforts, and then refinance out pretty cheaply and efficiently with a long-term product.
Love that. So for anybody who's wondering, when Chris says, what the exit costs would be, what he's talking about is any sort of prepayment penalty. And maybe you can talk a little bit about the different types of prepayment penalties that we need to be aware of in the commercial sector.
Sure. So when you buy assets, Tim, your intent is to always refinance into a longer term product. So we want to be very conscious about the acquisition and and renovation loan to make sure that you're not being constrained when you stabilize this thing at 12 to 24 months. So a bank that's floating rate or a bridge lender that's floating rate is going to have no prepayment penalty. Credit union, across the programs don't typically have prepayment penalties.
Mm-hmm.
Now, once you refinance into this longer term product, whether it's CMBS, whether it's a life insurance company or an agency loan, the word you're going to hear quite often is yield maintenance. So when you get into this longer duration product, this 10-year fixed rate loan, the lender is able to offer extremely attractive rates and terms because they intend to put their money out for 10 years. If you go ahead and you pay this loan off in year 4 or year 5, the lender's going to say that's okay to do so, but you need to maintain my yield for the rest of the loan term. So I anticipated 10 years of interest. You can pay me off early, but you need to maintain my yield over the next 4 years, assuming that I only reinvest in the corresponding treasury. That's yield maintenance. Now, we can always, for some sort of premium, say if the coupon on the loan was 4.5% yield maintenance, say we pay 4.60 for the next 10 years, but instead of having it be yield maintenance, there's a declining scale prepayment penalty. So maintenance.
So let's talk about yield maintenance real quick. So
sure.
If I have a 4.5% interest rate on my loan, and it's a 10-year loan, and I pay it off in year 5, right? So for the next 5 years, I have to maintain a 4.5% on $10 million. That's a sizable amount of interest that I need to catch up on. But it's not just about that. It's the difference. It's the delta that you would owe if they took that money and they put that $10 million into a U.S. Treasury and what that bond would yield, right? Correct. So if that bond would yield a 3% and you're at 4.5%, essentially you would only owe 1.5% on that for 5 years, and that would just be your prepayment penalty. Is that correct?
Every year for 5 years, discounted back because there's some amortization in there, and then discounted back again for the present value of that. Yep. So you're going to take the corresponding U.S. Treasury. So if it's 5 years left, you're going to take the 5-year UST, take that difference, discount it back for amortization and a discount rate, and that's going to be your approximate prepayment.
So you got to do some math on this, on that side of things. And then the other one is the declining scale prepayment. So talk a little bit about that.
Sure. So your typical bank loan that's on the balance sheet that's 5-year duration would be 5% year 1, 4, 3, 2, 1% declining scale over the life of the loan. Now, if you wanted a life insurance company loan, these guys are holding the loan on the balance sheet. You could pay a little bit of a premium to get yield maintenance for. I'm making up an example for yield for the first 5 years, and then a 5, 4, 3, 2, 1% declining scale on the back half. You can do the same thing with Fannie Mae. You can do the same thing, of course, with the life insurance company.
Meaning, okay, so if it's a 10-year loan term, like this is what most of, I think, I don't know. Do most of mine have this, or do most of mine have yield maintenance?
Most of yours, you're taking the lowest possible rate because, again, we're coverage constrained,
right,
quite often. So you're going to take the lowest rate with the yield maintenance, for the life of the loan. Yep.
Right.
Some 10, some 12. It just depends on the objectives of that particular transaction.
So conversely, this step down, if you have a 10-year loan term, essentially in that first year, it's usually 5%. First 2 years are usually 5% of whatever the principal balance is. is what your prepayment penalty is. So year 1 and 2 would be 5%. Year 3 and 4, it would be 4%. Year 5 and 6, it might be 3%. Year 7 and 8, it would only be 2% prepayment penalty. And then year 9 and 10, pretty much up to what, like the last 90 days of the loan,
Correct.
there's a 1% prepayment penalty. And then the last 90 days, there's no prepayment penalty.
So open at par, correct.
So it steps down the longer you own the loan. Yep. The longer you've been paying on it, it's a step down of how much you owe based on the principal balance of that loan. So,
correct.
Good stuff, man. So tell me, what would you say? This is good, man. This is like nerdy math stuff, but it's like really, really important, especially when you're doing commercial real estate, commercial finance. Like everything's run by the numbers here. So this is like absolutely critical information and really, really good stuff. So again, man, appreciate you sharing. Tell me a little bit about what are the top, I don't know, few things that somebody can do to make themselves super bankable. So I know that in residential real estate, it's maybe only 10% property and 90% on the individual. In commercial real estate, it's conversely only about 10% on the individual and about 90% on the property. What is the bank looking for, one, in the sponsor or the borrower? And then what are a couple of things that borrower can do to make themselves look amazing on paper, right?
Sure. Yeah, good question. So I would say that loan requirement, that borrower specific requirements vary from lender to lender. But as I would always tell your listeners and your investors that we generally look for, as a rule of thumb, net worth of the loan amount and post-closing liquidity of 10% of the loan amount. So
right.
What does that mean?
Yep, good.
So what does that mean? So let's say we're doing a $5 million loan. We would want to have the person signing the non-recourse carve-outs be worth collectively, if there's more than one sponsor, $5 million. So that's net worth, which is total assets minus total liabilities. So you own $10 million of real estate. You owe $5 million. You own 100% of that $5 million. That's left, that equity. That would be net worth of $5 million.
Mm-hmm.
And then we need post-closing liquidity of 10% of the loan amount. So that's $500,000. So that can be stocks, bonds, mutual funds, cash, collectively making up $500,000. That's the first.
Is there anything that doesn't count in that? Your personal residence counts in that. Do retirement funds count in that? Roth, like all those types of accounts, all count, right?
The answer is it depends. It depends on the lender, and it depends on the account. So if it's a true retirement account that you can't really get at except for massive penalties, a lot of lenders aren't going to count that, but a lot will. So I would say 50% of the lenders are going to allow retirement accounts to count, 50% will not.
They'd probably allow it for net worth, but maybe not the liquidity standpoint. Right?
Absolutely, for net worth, they wouldn't count that as true liquidity.
Got it.
So I think that's the first thing that we're looking for is let's just make sure that on paper, we're hitting those minimum requirements. Depending on the lender, there's not as much scrutiny given to personal tax returns as you would with the residential mortgages. Mm-hmm. But we want to make sure that we at least have all of those items in a nice complete package, including the K1s, to be submitted to the lender. So the institutional lenders are more worried about net worth and liquidity, real estate ownership experience, and then a global cash flow from a property development standpoint, the actual commercial real estate cash flow, than the actual personal tax returns.
Yeah, I mean, we're doing commercial real estate, right? Like, so even though we have cash flow, a lot of times we have depreciation that can offset a lot of that cash flow and a lot of our earned income. So that way, as real estate investors, our tax liability might be a little bit lower than, and on paper we might not look bankable, right? But these commercial institutions, these commercial lenders know the game. They know how the game's played, and they can see past a lot of that stuff. How about, okay, so we're talking about net worth That's important. Equal to the loan amount. Liquidity equal to about 10% of the loan amount. How does credit score come into play, and maybe past credit issues? I mean, obviously there's still some people out there with lingering maybe foreclosures or short sales or things like that on the record from the last downturn. How does that affect or adversely affect the lending environment for those folks?
Sure. So we're always going to run credit, and I would say we don't need 750, 800 credit scores. You think of real estate owners as really wealthy guys. We don't need to see perfect credit. In the high 600s is still going to be acceptable. So credit is just something to be aware of, be transparent with, know your scores, be forthright with your information. Let's just disclose everything up front. That's the same with previous credit blemishes. If you had foreclosures, if you had modifications, if you had bankruptcies, none of those are non-starters. We just want to really understand what led to those instances and put together a nice, clean, write-up explanation of what happened so that everybody knows you're not trying to hide anything. They will inevitably come up. So let's just walk through the front door with them, explain what happened. We played nice in the sandbox. This is how we dealt with this stuff. And, nobody took a loss, and we all moved on. So big picture.
You want to hear the story behind it, right?
Yep. And so let's just put together a nice, clean story up front to submit that on day one instead of day 44 when we're trying to close it.
All right, good stuff. So how about this scenario? What if I'm an entrepreneur in a traditional business, not real estate related? I make a lot of money, or I'm a doctor or an attorney, or I don't know, something in a white collar profession, or an entrepreneur making a lot of money outside of real estate. I don't know anything about real estate, but I have the net worth, I have the liquidity, I have the credit score. Will the bank still lend to me on a $10 million apartment building that's 250 units?
Sure. So the bank,
I don't own anything other than my primary residence.
Yeah, depends on the leverage, right? So there depends on a lot of things. It depends on the lender, it depends on the leverage, it depends on where it's located. I think the first things first is the lender's going to say, who's going to manage this, right? We want competent, local, third-party management put in place that's going to run the asset. Now, I also think that on a loan that size for your first one, you're going to want to bring in a partner, right? So somebody who has experience, that if decisions need to be made, if we need to replace the management company, somebody that can vet the new group. I think the first one's going to be important to bring in an experienced partner. From a net worth liquidity standpoint, this guy is going to be strong enough, right? So the lender's going to want him to sign on the non-recourse carve-outs. But I think from an experience perspective, you're likely going to want, at least for the first one, to have somebody on your team.
Absolutely. And I mean, you've seen the deals that we do. We buy a lot of distressed properties. We buy them for pennies on the dollar. And the reason we get those is, I'd say a good chunk of those people are usually mom and pop owned and managed. And, they sucked all the cash flow out of the property. They never put anything back into the property, and they painted themselves into a corner over the course of the past 20 or 30 years. And now they don't have any money to put back into the property, so they're forced to sell. But the other side, the other person that we buy a lot of property from, as you've seen, Chris, are these entrepreneurs. People who make a lot of money in their traditional business. They look at apartment buildings, they watch HGTV, and they think that they can buy apartment buildings on their own too. And they make a critical mistake of not having a boots on the ground partner, of not vetting different management companies, and then just deploying their capital into something and hoping it takes care of itself. This is a business. It's like going and starting a restaurant, right? Or going and starting, you're selling widgets, or it doesn't even matter what it is, but you're starting a brand new business. And a lot of people don't give it the attention and the detail that it deserves, and they get kicked in the teeth because of it. And so a lot of the people I buy my properties from are from really smart entrepreneurs who make millions and millions of dollars, needed to deploy their money into something, and then they get punched in the gut over and over again because they didn't have a boots on the ground partner who had equity in the deal that, was compensated based on how well the property performs, or they didn't vet the different management companies, and they were taken and essentially stolen from by the different management companies. I see it all the time. And so, no, I'm glad you brought that up. That's a really, really good point. So
I would remind you of the property that you bought just outside of Atlanta. The guy that you bought it from was a cabinet builder.
he was in the trades.
He was in the trade. So he went into all these apartment buildings, installed these cabinets, and said, "I can do this," right? And we had to buy it from him at 20% occupancy, and really run into the ground. But man, did those have some nice cabinets.
Beautiful cabinets, gorgeous cabinets, best cabinets of any building that I own. The cabinets are unbelievable.
Yeah, cash flow wasn't so good for him, but beautiful cabinets.
If only he could pay his bills. No, I mean, it's unfortunate, right? This is a guy who deals with real estate investors, works with investors and contractors and management companies every single day of his life. He's like, hey, if these guys can do it, I could probably do it. Maybe, let me just go and buy something. Didn't have a partner, still had a primary business, got kicked in the teeth so hard that he lost not only his property, but his business. He went totally BK, I think. And dude, you got to come back from all that stuff. So you got to partner up with somebody who knows what they're doing, excuse me, from an operational basis to ensure that, this is a multi-million-dollar investment you're making. You want to make sure that's in good hands. So, no, it's important stuff.
So those guys, and then the other point that I just real quick before we move on is if you're very successful in your widget business and you've built a big balance sheet and you've built all this cash, why are you trying to spend your time in operating buildings? Mm-hmm. You can strategically align yourself with any one of successful real estate investors out there. Keep making your money, keep growing your business, invest passively with guys that know exactly what they're doing. Enjoy the cash flow, enjoy the returns, but don't take your eye off your money making baby.
Absolutely. I mean, why would you try to mess up something? You're already, you're focused. You spent 10,000 hours perfecting your skill set, and you want to go and start something new. As entrepreneurs, I get it. We like to test out new things, and a lot of times, it's something else that's fun or exciting or different. But the reality is, man, if you want to make a lot of money, if you're inspired by building legacy wealth, stay in your lane, get really, really good at what you do, double down on that traditional business, let it be boring. The more boring the businesses I see, the more money they make, and then invest passively, like you're saying, into different operators. There's guys like me, there's guys all over the country who are great operators who would gladly partner up, pay a solid return, and give you equity in the deal in order to do more deals together, build some long-term wealth. And that way you can lean on somebody else's 10,000 plus hours of experience without having to go through those learning curves. And by learning curves, I mean lose a shitload of money and get kicked in the teeth for years and years and years without doing that. So definitely partner up. I love that advice. So we talked a little bit about what somebody can do if they have the net worth and they have the liquidity, on how to partner up with somebody, either a great management company or bring in a joint venture partner who's a great operator. What if somebody has the experience, but they don't have the net worth and liquidity? Like, I didn't even realize that this was out there, but what are some resources for those people?
Sure. If you have experience, maybe you're doing fix and flips, maybe you own a bunch of single family homes, you know how to operate real estate, you know how to find good deals, but you just don't have the balance sheet to get a lender comfortable to use traditional mortgage financing. Well, there are sophisticated real estate guys out there with big balance sheets that would love to partner up with you strategically when you have good deals, right? So just because you come across a $4 million deal that you don't have the net worth and the liquidity to qualify for, doesn't mean we should pass on that deal. Reach out to guys like me, reach out to guys like Tim, because for the right opportunities, we can partner you up with guys that can qualify without gouging you for the entire deal. There are sponsors, there are JV partners, there are guys out there that would love to help you get it going and still maintain a really fair share of the deal.
What I love is that we're talking about big deals, especially like I came from the residential investment space. And when you're investing in single family houses, you're looking at, a $20,000 or $30,000 profit spread, right? After you flip the house and you pay for all your broker fees and your commissions and your closing costs and all these things, I don't know, you're making 20, 30, 40 grand. And like, that's cool, but there's not enough juice in the squeeze for everybody to get paid in that. So you as the operator either need to be Superman or Wonder Woman and do all aspects of the deal. Versus in commercial real estate, my favorite thing about commercial, I mean, obviously legacy wealth is a big piece of it. But my other favorite thing is that I can focus on what I'm really good at, on my unique ability, on my core competency. My team can focus on theirs. I can bring in joint venture partners who are amazing at construction and project management. And I can afford to pay Chris his fee, and I can afford to pay a broker their fee, because we're talking about not tens of thousands, not even, we're more than hundreds, probably millions of dollars of equity in these projects, and millions of dollars of profit that can be carved up amongst everybody. So even if you have a portion of that, like a saying that I say all the time is, I'd rather have 25% of a watermelon versus 100% of a grape. There's a lot more juice in the squeeze of 25% of a watermelon than there is in 100% of the grape. And it's a lot more fun to own 25% of a watermelon and just do stuff that you're good at and stuff that you like doing than try to do everything and own 100% of a grape, So that's been a big deal and a big mindset shift. It takes you a lot from like a scarcity mindset to more of an abundance mindset. And it's a muscle you really have to work out and exercise in order to strengthen that and really understand the opportunity there. In this equation, it's not traditional math. 1 + 1 here equals 3. You can do a lot more as a collective group than you could as individual parts. So that's powerful stuff. Let's talk about this. Where do you see the lending environment going over the next 12, 24 months? So, we've seen people talking about this inverted yield curve. We've seen people talking about, hey, we're at the peak of the market. You see all these different reports from firms like yours, Marcus & Millichap's, coming out and putting these market reports together saying that we're at the peak, or we're even over the peak, and we're on the side of it. Like, what does all that look like? I know the Fed's been saying the interest rate's staying steady for the next 12 months. What's going to happen next year, an election year? Like, there's a lot of moving parts. What are you seeing from your end on the finance side?
Sure. So I think the first comment that I'd make is I don't predict interest rates. If I could predict interest rates, I wouldn't be mortgage banking. I'd be making a lot more money. So I want to caveat everything that I note with I don't predict that. Now, what I will tell you in what I'm seeing with a lot of my guys is they're taking as much money as they can off the floating rate stuff right now, and they're putting it to longer fixed rate permanent financing. So we're in a really unique time where prime, one of the benchmark interest rates, is at 5.5%. I'm doing 10-year fixed rate loans right now at 4.6%, or even with the life insurance companies down around 4%. So longer money is substantially cheaper than floating rate money today. So I would say that's step number one, is that everybody is taking anything that's got short duration terms and fixing it out at current low interest rates,
which historically has been an indicator of a coming recession, right?
Yeah, they say that longer durations of inverted yield curves is a signal of recession. Yeah.
Right. So that's not to be anything afraid of, though. Like, that means there could be some opportunity. There's probably a lot of people in real estate who shouldn't be in real estate right now, and it could cool off that, a little bit of the competition. And then at the same time, might create some realistic expectations in sellers' minds versus them thinking they're going to get top dollar and above retail price for all these different things. So for me and my team, we actually see it as more of an opportunity that's coming up, because we are putting long-term debt in place, fixed interest rate debt in place. long-term amortization schedules to allow for more cash flow. So that way, if things do cool down, if things do shift, if the market does change, then we're going to be very bankable when all that stuff happens. So, so that's good insight. What else you got?
Yeah, I would say that I suspect that as the market cools off a little bit, it has to inevitably cool off. The market is extremely aggressive right now. I think you're going to see a little bit of underwriting tighten. Right now we're able to do 80% loan to value cash out deals. I suspect that, if the market cools off a little bit, you're going to see LTVs come in 5 bips, 10 bips potentially. I also think that,
so instead of getting 80% loan to value, you're saying we might get 70 or 75% loan to value.
Correct. That I suspect that day could come. Right.
And when we underwrite our deals, we're always doing that. We're always expecting that, hey, today we could probably get 80%, but let's underwrite this as if on the refi, we're only going to take out 75% just to make sure that things are safe.
Sure. So when you and I look at deals together, what we do is we say, we expect the cash flow to be here in 18 to 24 months based on current deals that have got done over the last 6 months at, let's say, 75 or 80% loan to value on this comparable product for a refinance. My team and I would cut that leverage back 5 bips for your models. That's just a conservative way that we've underwritten deals
for your group a little bit too, right?
We do. Yeah. So if we're doing 4.5% 10-year fixed rate deals, we might underwrite it at 5 or 5.25 as a stress on the refi. We might also say if 4 or 5 comparable deals have traded at a 7% cap rate in this market, we might bump that up 25 basis points on the refinance for stabilized value.
And you do that because you want to stress the financials. You want to make sure that you're underwriting these things very, very conservatively, especially with where we are in the marketplace right now. You don't ever want to force a deal. We try to kill every single deal. If we can't kill the deal, then I know it's a good deal. And if you can stress the financials this way, with a lower loan to value and with a higher interest rate, God forbid nothing changes and the market's this strong still, right, 12 months from now. Imagine what the returns are going to look like then, sure, right? So if you can make it work at very, very conservative underwriting, then and nothing does changes, or even if it changes less than what you're stressing it at, your number is going to come back real, real strong. For at least if you follow me and if you follow the way that I structure my deals, when you're turning these things over in 12 to 24 months, that's a more predictable time frame than, let's say, 5 years out, right? 5 years down the road or 7 years down the road. It's hard to assume, we could have 2 different presidents in the meantime. We could be in war with China. We could have a big wall built. I don't even know. There could be all sorts of political uncertainty and an economic uncertainty and all sorts of things going on over the course of 5 or 7 years, where it's very hard to predict out that far. We can have a pretty good indication of where the market's going to be in the next 12 or 18 months, which is typically what it takes me to turn around a property and then put the long-term debt in place. Offers a little predictability on that. So we already talked about how to minimize some downside risk and capitalizing on opportunities when the market shifts. Other things, is there anything else that, before we move on, anything else that we should be aware of as investors from the financial sector that you can think of?
I would say that the most important thing that you guys can control is basically control what you can. So if we can put long-term debt on something and fix an interest rate, fix an amortization schedule, and know what the controllable debt service is going to be, right? We don't know necessarily what the market's going to do. We don't know what occupancy in any particular market's going to be. We don't know what rent's going to be. But if we can take one piece of the puzzle and fix that thing in, we want to be able to control what we can.
Yep. Love that. So, Chris, you work with a lot of perceived smart people, right? Real estate investors, people who have a lot of wealth, have big balance sheets, have a lot of liquidity, a lot of net worth, who are really growing their legacy wealth, right? From a from a perspective of looking across all your different clients, are there certain commonalities that you see among different investors, the smart investors, and the people who really have, I don't know, short-term vision, long-term vision, the types of deals, the types of assets they're buying, their mindset, um, how they structure deals? Are they more strategic? Are they more tactical? Give me some like insight on maybe some commonalities that you see amongst your different clients. I think it's interesting to
Sure,
think about the psychology that some of these people, that legacy wealth builders have, right?
sure. So I want to caveat that by saying I sit in Cleveland, Ohio. So I'm a Midwest guy. Most of my clients are Midwest guys. There's a different way to build wealth in the Midwest than there is on the coast. There is there is a ton of rent growth and appreciation on the coast. We don't enjoy that as much here in the Midwest. So the main thing that I see from my guys that build, $100 million balance sheets, $200 million balance sheets is the benefit of long-term ownership and amortization. Okay. So when we talked about net worth, we talked about the value of the assets minus the amount of debt that's on the assets. So amortization over 10, 15, 20, 30 years of property ownership really accrues to your benefit, right? So if we start with a $10 million asset that has $8 million of debt on it, and it appreciates to 11 or 12 million, and that $8 million of debt amortizes down to, over the first 30-year amortization, not too much. Maybe we're only paying down 16, 17% of that. But then 10 years from now, we refinance and we don't pull out every last dollar, and we start amortizing this on a 20 or a 25-year schedule. Now, all of a sudden, we're really, really starting to amortize this stuff down, and we've built a lot of equity in these assets. So, we see a lot of apartment deals get done with Fannie and Freddie type loans, 10-year fixed rate loans, a little bit of interest only, long amortizations. But the clients that are the wealthiest guys convert that stuff to longer term, a little bit tighter amortizations after they've repaid their investors. Life insurance company financing guys are the guys that have the strongest, best durable, most durable balance sheets.
Interesting. So I love that, man. I love the idea of, obviously, when you don't owe anybody anything on your property, they can never take anything away from you. Like that's the best case scenario. But like I'm in high growth mode, right? So I'm buying, I'm putting debt on properties. Sometimes we're even doing cash out refinances. We're able to take some debt off the plate, putting additional debt on the property, even more than what our cost basis is, just so we can take a little bit of cash out and then redeploy it into other deals. Because if the money's at 4.6%, like you're saying, and I can deploy it over here and get a 10 or 11 or 12% cap rate. Some of my deals go up to 15, 16, 17% cap rates in A and B class areas too. It makes a lot of sense to do that. And I'm, diversifying the risk and, have more cash flow over here now too. And as we continue to grow. But it's a big deal. And I don't think people realize how much you can pay down on these properties over time. And like for me, I put 30-year amortizations on all my properties. So as you're saying, if I just make the minimum payments every single month, I can, I'll pay down probably, 17, 20%, somewhere in that of the total principal loan amount, right, over the course of the next 10 years until I have to either refinance or sell the property at that time. But for me, I still like the longer term amortization. The reason being is because if the market does shift, I don't want to be forced to make a bigger payment than I would on a 20-year AM or a 25-year AM, right? I can still make an additional principal payment once a year and pay this thing off in 20 years if I wanted to. But I don't want to have to do that. Does that make sense? So it gives you
Sure.
more options. Of me personally, I just like the idea of putting a 30-year AM, having more cash flow. And then if I have so much cash flow and I want to make like an extra payment or two, I can still pay this thing off in 15 or 20 years if I wanted to, but I don't have to do that in case the market does shift, in case occupancy does drop, in case rents drop, any of those things happen. I still have plenty of cash flow on the property for where I am right now. Now, if I was buying something, in 2010, 2011, 2012, after the market already shifted, and you're paying 30 cents on the dollar, yeah, put a 15-year AM on there or 20-year AM on there, and it makes a lot of sense because it's all paid off. You're just every check you write to the bank, you're taking money from this pocket and essentially put it into this pocket in principal pay down, right? So yeah, it makes a lot of sense, dude. And I think one of the biggest key factors to building legacy wealth is by holding properties, right? And letting it appreciate over time, letting it naturally appreciate over time, not speculate, just, assuming it's going to bump up a little bit year after year after year, but over the course of 10, 15, 20 years, it makes a big impact on the value of the property, and then letting that loan balance get paid down over time. And then all of a sudden, 20, 30 years from now, you're sitting on hundreds of millions of dollars, or tens of millions at least, of property that you own free and clear. And you either have a ton of cash flow, you can refinance it again, you can sell it, you can do whatever you want. And I think that's a major factor of just consistency. Don't wait to buy real estate and then wait, and just consistently making payments on the principal pay down and letting the property appreciate. I think it's powerful stuff, man. It's amazing how that compound effect sets in. So that's good stuff, man. Dude, I appreciate you. I appreciate you being here. For anybody who doesn't know Chris, you guys need to know him. We'll put his contact information in the show notes. And just as a quick aside, like, dude, you only charge 1% on these loans. So I hope I'm allowed to say that. Hope you don't mind that I say that. But like, dude, I see you as such an asset to my team that I love paying you, and it's only 1%. So dude, your team takes care of everything. You guys understand me. You understand my financials. Obviously the first couple deals we had to get acclimated. You had to understand my business model and how we do what we do. But now I send you a deal, and you guys are essentially my transaction coordinators all the way through. And there's different ways to have a conversation with a bank if I was going to go have that conversation versus you going and having that conversation. It's very important to understand the different dynamics and the posture that you can take with a bank versus me trying to take that posture with the bank. And you knowing what the bank is looking for, and knowing my story, and being able to formulate it and structure it and frame it in a way that is mutually beneficial for both of us. It's powerful stuff, man. So dude, I appreciate everything that you've done. And do you have anything else that you want to share? And then I'd love for you to share your contact information with everybody too.
Yeah, Tim, look, I can't thank you and your guys enough. We've had a really good run with you guys, and we love working with you, and we're thrilled to be a part of growing your balance sheet and you guys creating legacy wealth for you and your family. So thanks again for having me on. Again, any of your followers, your partners can reach out to us. The best way to get a hold of me is my email address, christopher.litzler@marcusmillichap.com. And our main line, you can get a hold of any of us at 216-328-9700.
Awesome. Dude, I appreciate you. We got a lot of deals in the pipeline too. So I need you to get back to work pretty soon, buddy.
We're on it. Thanks, buddy.
All right, man. I appreciate you. Hope you guys got a ton of value out of this. This is great stuff. Chris Litzler with Marcus and Millichap. And again, his information will be in the show notes. So awesome info on how to build legacy wealth and the commercial finance side of these things, what banks are looking for, and what you need to do, and how you can get involved in some deals, even if maybe you don't qualify for the financing, how you can get involved in building some legacy wealth through commercial real estate. So Chris Litzler, everybody, I appreciate you, bro. Talk to you guys soon. Be your best.